There are three mistakes that we often see high income families make when it comes to tax planning for the year. The first of which is understanding the impact of whether I itemize or whether I take the standard deduction on taxes. So, as a reminder, this year, everyone in America, married filing jointly, you get a deduction of $32,200. In order for deductions to count against your earned income, you need to have total deductions well north of 32,000. That's actually further compounded for high income families, and the reason why is individuals in the highest tax bracket. That means your earned income is, around $800,000. 2/37, yes, that's correct. 2/37 of your charitable contributions are not deductible. So what does that mean in practice? If you're charitably inclined, it makes a lot more sense to bunch donations in a given calendar year and then go use the standard deduction the next year. That's the first mistake that we see, is that people are not planning their itemized deductions to maximize the value of this higher standard deduction that we have under the tax law. The second mistake that we often see high income families make is not being aware of what we have diagrammed here. This is what many people are calling the SALT torpedo. So SALT stands for state and local taxes. Those are the taxes that you pay at the state level. You get to deduct that against your federal taxes. But under the 2025 OBA tax bill, what it did was it said if your modified adjusted gross income, so for many people, this is your income after your 401k, HSA deductions, FSA, things like that. When your income falls between this $500,000 to $600,000 range, you lose 30% of your state and local taxes deductibility. So what I mean by that is, let's say you have your property taxes and your income taxes. Let's say that you're paying a total of around $40,000 every single year, and your income is right here at $50,000. You get to deduct $40,000 against your taxes. As we go down here, for every dollar that you earn, you lose 30 cents in deductibility. So what that means in practice is that when your income goes all the way from $500,000 and it grows to $600,000, now we're only able to deduct $10,000 against our state and local taxes. So this is really important for families who are able to kind of time their income a little bit better, whether that means you're an entrepreneur and you're taking profits out of the business, maybe you're accelerating some expenses as well. Remember, you can kind of prepay rent, or maybe you're purchasing some equipment for your business. That's part one. Or the second part is for individuals who receive a lot of money off of W-2. Sometimes if we have phantom income, whether that's from different types of stock incentive plans, ISOs and so forth, this can be something we want to take a look at so that we're not losing our SALT deductibility on our taxes. The third and final, often overlooked tax planning technique that we see for high income families is on 529s. So remember, on 529s, this is a very state by state specific rule. Depending on what your state has written out for what you're able to do and the types of plans you can have within a 529, you can make contributions every year. So I'm going to use round numbers here. Say that in the state of Indiana, you get a deduction for the first $7,500 in contributions that you make to the 529. That gives you a tax credit. Very many times we see people stop at that number, and that's $7,500. But in reality, we're able to gift even more. So what does that do in practice? You have money today. Let's say you have $10,000 that you're gifting per child, and you have two kids. You're going to do $20,000 a year. That $20,000 a year is split evenly. $10,000 per child. Let's say that they're at the ages of 5 and 9. We're looking to grow that money over the course of years. We take it, we grow it. I'm going to use round numbers. Now it's at $50,000 by the time that they're going to college. And this one, let's say that this hasn't done as well. It's at $25,000. In this scenario off to the left, you just made $40,000 tax-free so long as it is used for college expenses or education expenses on the most part. So if you're in a high income bracket and you're getting taxed at around 20% on your gains, that just means that you just saved $8,000 in taxes. Many people come and they say, I understand that I can grow this money tax-free for college, but I'm not sure that I'm going to have both of my kids go to college. In that scenario, you're able to actually redefine who the beneficiaries are of the 529 plan. And in fact, you can give a 529, you can actually convert it into a Roth IRA for your beneficiary. So for your child, you can do around $35,000. So it doesn't have to be used just for college. Under the tax bills, there's actually a little bit more flexibility. And on top of it, people do not appreciate the value of being able to have that money, have it compound tax-free, and to be used for the total amount of opportunities that it can be as it pertains to secondary education. Thank you so much. Bye-bye.